So our discussion for today will be impairment of assets covered by IAS 36 with the same title, Impairment of Assets. The coverage of our discussion for this session will be the following. We have objectives and scope, definitions, identifying an asset that may be impaired, measuring recoverable amount, recognizing and measuring an impairment loss, cash generating units and goodwill, and reversing of an impairment loss, as well as the disclosure requirements. So to start with, let us have the objectives and the scope. So the primary objective of IAS 36 is to prescribe the procedures that an entity applies to ensure that the assets are carried at no more than their recoverable amount. So the main goal here is to make sure that our assets are not overstated. So with the objectives being said, the standard also emphasized that an asset is carried at more than its recoverable amount if its carrying amount exceeds the amount to be recovered through use or sale of the asset. So when you talk about use, it pertains to the value in use. This is also known as the entity-specific value for what we already discussed in the previous topics. So entity-specific value is basically pertaining to the value in use. And then for sale, this pertains to the fair value less cost to sell. So if this is the case, the asset is described as impaired and the standard requires the entity to recognize an impairment loss. The standard also specifies when an entity should reverse an impairment loss and prescribes certain disclosure. So these are all the items that we're going to discuss. So for the scope, the standard will be applied for basically all types of assets except those that are covered by or except those that are indicated in the list below. So we have until letter G. Okay? So let us discuss. But before we itemize them one by one, we simply emphasize that the reason why they are not considered or why the standard IAS 36 does not cover these particular items is because the specific standards have already provided certain information on how the recoverable amount or how the impairment is going to be measured. So, first item that is not covered by IAS 36 will be inventories. The reason is because in the case of inventories, the write-down of inventory is based on the lower of cost and NRV. So it is not going to be based on the value in use and fair value is cost to sell. Okay? Letter B, contract assets and assets arising from cost to obtain or fulfill a contract that are recognized in accordance with IFRS 15 revenue from contracts with customers. So again, there is a specific provision already on how to value contract assets. So therefore, it is not going to be covered by IAS 36 because it is already covered by IFRS 15. Letter C, deferred tax assets because it is covered by IAS 12. In the first place, deferred taxes are not usually subject to impairment unless it is not recoverable anymore. So if it is not recoverable anymore, there will be a simple derecognition of the deferred tax asset. Letter D, assets arising from employee benefits because it is covered by IAS 19 and the measurement of your plan assets or the assets that are arising from employee benefit transactions are actually not measured based on fair value less cost to sell or value in use, but rather they are measured based on actuarial assumptions. Letter E, financial assets that are within the scope of IFRS 9 financial instruments because there is a specific computation for its impairment because it is either going to be based on the fair value adjustments or based on the measurement as provided in the amortization or the amortized cost. Letter F, investment property because there is a separate measurement for investment properties that are measured at fair value. So take note, if the investment property is measured at fair value, it is the impairment is not covered by IAS 36. But if the investment property is being measured using cost or using the cost model, then it will now be subjected to your impairment losses under IAS 36. And finally, letter G, biological assets related to agricultural activity within the scope of IAS 41 that are measured at fair value less cost to sell. So once again, the reason is because it is already measured at fair value less cost to sell. So there is no need to measure impairment losses because it is based on fair value already. But if it is using cost, then there will be or it will now be covered by IAS 36. Oh, sorry, I forgot. There are other items. I forgot the two items here. So, letter H is contracts within the scope of IFRS 17, insurance contracts. So, because it is covered by IFRS 17 and the impairment as covered by IFRS 5, non-current asset non-current asset held for sale because there is no concept of value in use in the case of IFRS 5. So that is why if we discuss the specific standards, you will see later on that under IFRS 5, there is no such thing as value in use because the item will be held for sale. So therefore, recoverable amount is simply your fair value less cost to sell. All right. So with that, we continue. We need to understand and to emphasize that the standard will still apply to financial assets that are other than financial assets covered by IFRS 9. So meaning those that are considered as investments in subsidiaries, investments in associates, and investments in joint ventures, they are still subject to impairment. And the impairment measurement will be covered by IAS 36, this topic. And the basis will be as if these are cash generating units because they really are cash generating units. So with that, let us now proceed with the definitions. So the first item to be defined will be carrying amount. So the carrying amount is again the amount that is reflected in our financial statement as recognized after we deduct your depreciation or amortization and any impairment losses. A cash generating unit is defined as the smallest identifiable group of assets that generate independent cash flows. Okay. We have corporate assets, which are assets other than goodwill that contribute to the future cash flows of both the cash generating unit under review and other cash generating units. So basically, corporate assets are can be simply termed as common assets, which are servicing or which are being benefited from by more than one cash generating unit or more than one group of units of the business or divisions of the business. Next, we have cost of disposal, which are incremental costs directly attributable to the disposal of an asset or cash generating unit, excluding finance cost and income tax expense. So, cost of disposal can also be termed as cost to sell because these are similar in nature. We have depreciable amount, which is the cost of an asset or other amount substituted for cost in the financial statements, less any residual value. And then we have the depreciation or amortization, which is the systematic allocation of the depreciable amount of an asset. We have fair value, which is again going to be based on IFRS 30. So when we talk about fair value less cost to sell, in the case of the recoverable amount, we simply refer to IFRS 30, which is better at this point because there will be no more arbitrary or judge or subjective judgment when it comes to measurement of fair value because we already have a specific guide, which is IFRS 30. So as you can see, almost every standard refers to IFRS 30 when it comes to fair value. And then we have impairment loss, which is the amount by which the carrying amount exceeds the recoverable amount. So when you talk about the recoverable amount, it is simply the higher between the fair value less cost to sell or less cost of disposal and value in use. When we talk about useful life, the useful life is either based on the period of time by which we can use the asset or the number or expected productive capacity expected from the asset. Then finally, we have value in use, which is the present value of future cash flows expected to be derived from an asset or cash generating unit. So going back This is pertaining to the continual use until until eventual disposal of the asset. So with that, let us proceed with the next portion. How do we identify if an asset is impaired? So first and foremost, according to the standard, the entity has the responsibility to assess at the end of each reporting period whether there is any indication that an asset may be impaired. Okay? If any such indication exists, the entity shall estimate the recoverable amount of the asset based on the provision of the standard. So it is a mandatory, or it is required from all entities, okay, to measure or to determine whether impairment exists on all assets covered by IAS 36. And it will be done on an annual basis. So at least annually, there should be an impairment testing, or a determination of impairment. And then, in addition, irrespective of whether there is any indication of impairment, an entity shall also test the impairment, or test for impairment, any intangible asset with an indefinite useful life, okay, or an intangible asset not yet available for use, for impairment annually by comparing its carrying amount with its recoverable amount, and test goodwill for goodwill acquired in a business combination for impairment also annually. So for items A and B, regardless if there is an indication or there are no indications for impairment, you still test it. Okay? And the the basic concept, or the basic rationale for doing this, is because the items have indefinite life. So since there are indefinite life, it is not subjected to depreciation, which is in a way a representation of its impairment. But since these are not being depreciated, or these are not being amortized, then it is advisable, or in fact it is required for entities to test for impairment, so that we can assure that these are not overvalued at the end of each year. Next, still under the same topic, in assessing whether there is any indication that an asset may be impaired, we need to consider as a minimum the informations provided to us, such as any external sources of information, internal sources of information, or valuation techniques using the dividend. Because the dividend is actually a good indicator of whether there is impairment for our investments. Okay? So, this is as a minimum, so meaning other informations that can also indicate, um, that can also give us an information about the impairment of a particular asset can also be used. Okay? But at a minimum, these are the criteria, or these are the groups of information that we are going to use. So, under external sources of information, we have the following. First, okay, for external sources, there are observable indications that the asset's value has declined during the period significantly more than would be expected as a result of the passage of time or normal use. So these are external sources of information. So aside from observable indications, because basically, and you can actually determine if an item has retained its value, or has declined significantly as compared to the previous years. Of course, this will be based on the eyes of experts, because these are external sources. Letter B, significant changes with an adverse effect on the entity have taken place during the period, or will take place in the near future, in the technological, market, economic, or legal environment in which the entity operates, or in the market to which an asset is dedicated. So these are basically talking about obsolescence, okay, or whatever type of decrease in value as compared to the competitive nature of the asset that we are holding. And letter C, market interest rates or other market rates of return on investments have increased during the period, and those increases are likely to affect the discount rate. So, of course, if the market rate increases, it means that the value, or the present value, will actually decrease. So, if the present value will decrease, this means that the initial valuation will now be reduced. Therefore, it will result in impairment. Okay, letter D, the market, or the carrying amount of the net assets of the entity is more than its market capitalization. So, market capitalization can also be a basis, particularly if we are talking about investments in active markets. Because if the carrying amount is basically a lot higher as compared to the market capitalization, which is the amount perceived by the market as the actual value of the entity, then we need to measure the entity as a whole for impairment. Okay? So aside from that, we also have internal sources of information such as evidence is available of obsolescence or physical damage of an asset. So even if the information did not come from external or from experts from that are independent of the entity, if the entity itself can see that there is obsolescence or physical damage on the asset, then they can actually assess it already for impairment. Letter F, significant changes with an adverse effect on the entity have taken place during the period which are expected to take place in the near future in the extent to which or manner in which the asset is used or is expected to be used. So, what are examples of these items? So, this can pertain to assets that are now going to be abandoned. So, if the asset is going to be abandoned, it means that it has no more actual use in the near future or in the succeeding accounting period. So meaning we need to test it for impairment because if it is going to be abandoned, then it will not have any cash generating capacity for or benefit for the entity. Other than that, it is possible that they are going to dispose of the asset at a nearer period as compared to the initial assessment. So example, they initially estimated to sell the asset 10 years from the current period, and then after which management has decided to dispose of it earlier because similar to in the external information, it could be they want to buy new equipment or buy new assets to replace that particular existing asset. So these are some examples that will give us information or internal information about possible impairment. And then we have letter G. Evidence is available from external reporting that indicates that the economic performance of an asset is or will be worse than expected. So economic performance in the form of um, whether it can still produce at the same rate as it is producing right now or it is already declining in productivity and all of those similar information. So those are also considered as internal sources. And then we also have dividends. Okay, so in the case of dividends for investment in subsidiary, joint venture, or associate, the investor recognizes a dividend from the investment, and the evidence is the evidence that we have available indicates that the carrying amount of the investment in the separate financial statements exceeds the carrying amount that is provided in the consolidated financial statements of the investee's net assets including associated goodwill, or the dividend exceeds the total comprehensive income of the subsidiary, joint venture, or associate in the period the dividend is declared. So this the mere fact that we are receiving dividend in excess of the earnings, it means that the entity is already, or our investee or the entities wherein we invest are actually trying to liquidate already the share capital. So why are they going to do that? One of the reason is primarily because they are going to close soon. So that's one indication that impairment should be recognized. For item number one, there is overvaluation of the investment values as when it is reflected in the consolidated FS. So meaning it is overvalued already. So take note, when you are preparing the consolidated report, you are actually reporting it based on fair value. So if you are going to do that now, you can actually see whether the group of investments or the investment that you have in that particular entity is actually overstated or not. So if it is overstated, then it means that there needs to be measurement or recognition of impairment. Okay. So still under identifying whether the asset is impaired, um, we need to focus on internal reporting. So evidence from internal reporting that indicates that an asset may be impaired includes the existence of First, cash flows for acquiring the asset or subsequent cash needs for operating or maintaining it that are significantly higher than those originally budgeted. So meaning, if you are going to spend more for this particular asset, then its actual value to us is actually going to be declining. Okay? So, meaning, we need to determine or compute for an impairment as a result of lower expected net cash flows. Because take note, if we are going to have additional cost of operations, it is going to be attributed to our cash outflows. So if we are going to talk about value in use, if we expect to use the asset continuously until we dispose of it, then our net cash flows will become lower. If the net cash flows are lower, if we subject that to present value to determine the value in use, then the value in use will obviously become lower. So if the value in use is lower and compare it to the carrying amount, then it means that impairment really exists. Letter B, actual net cash flows or operating profit or loss flowing from the asset are significantly worse than those budgeted. So again, similar to how we explained letter A, because the cash flows are lower, the value in use will also be lower, which means that impairment might be existing. Letter C, a significant decline in budgeted net cash flows or operating profit. So again, based on budgeted information, the cash flows will be lower. So meaning value in use is lower, impairment exists. And letter D, operating losses or net cash outflows for the asset when current period amounts are aggregated with budgeted amounts for the future. So meaning we are expecting losses. So we do not actually expect any cash inflow anymore. So we have a net cash outflow which will ultimately reduce our total cash flows for the asset or group of assets, which means that there is impairment. Okay, so that's basically how to determine whether there are impairment. So since we are now able to determine whether impairment exists based on the information provided to us or indicators that are given to us, the next question there is, how do we determine the amount of impairment loss? So of course, based on the definition, impairment loss is actually based on the difference between the carrying amount and the recoverable amount, wherein the carrying amount is actually higher than the recoverable amount. So since the carrying amount is already recorded in our financial statements, the thing that we need to compute now is the recoverable amount. So how do we determine the recoverable amount? Again, under the provisions of the standard, we need to base it on the higher, okay? The higher of the individual asset or the cash generating unit's fair value less cost to sell or fair value less cost of disposal and value in use. So those are the two items that we are going to determine. Of course, in this case, it is easy to determine fair value less cost of disposal because we already have a basis for fair value, which is IFRS 13. So we look for all available information for fair value, whether that is level 1, level 2, or level 3 information, for as long as we can determine the fair value, and then deduct the cost of disposal. In this case, for cost of disposal, okay, other than those that have been recognized as liabilities already, the cost of disposal are deducted in measuring the fair value less cost of disposal. An example of this cost of disposals are legal cost, stamp duty, or these are documentary stamp, and other similar transaction taxes. We have cost of removing the asset and direct incremental cost to bring the asset into condition for its sale. So generally, these are also the same as our directly attributable cost in your other standards. So for as long as these are directly related to selling the asset. And again, this will not include transport cost. Okay, transport cost, because transport cost is not part of the cost to sell. Okay, that is not a point of sale cost. Okay, so that is for fair value less cost to sell. So practically, if we talk about fair value less cost to sell, this is similar to fair value for fair value for investment property, fair value for financial assets, fair value for biological assets, and all other types of assets that are using fair value. And cost of sale or cost of disposal is also the same. The more difficult way for us to determine the recoverable amount is actually the value in use. So as difficult as it may be, we cannot avoid determining the value in use, particularly if our real intention for the asset is to continue using it. Because if we will continually or continuously use it, okay, in our assessment, then value in use is really relevant. Okay? But of course, later on, if the value in use is lower than the fair value less cost to sell, then the fair value less cost to sell is still our recoverable amount, and that will be the basis for the computation of impairment loss. If any. So, anyway, let's proceed. Value in use is computed as with the following components. Actually, we have until letter E. So there are basically 5 components of value in use. First, an estimate of the future cash flows the entity expects to derive from the asset. It also includes expectations about possible variations in the amount or timing of those future cash flows. So meaning present value is involved. That's why the time value of money represented by the current market risk-free rate of interest is also considered. Letter D, the price for bearing the uncertainty inherent in the asset, and other factors such as illiquidity. Market participants would reflect in pricing the future cash flows the entity expects to derive from the asset. That's why it is more complicated when we try to determine value in use. But the bottom line here is value in use is actually the present value of all future cash flows relating to the continual use of the asset until its disposal. But of course, if you are not an expert in valuing the cash flows, then you cannot actually determine this by yourself. That's why most of the time, even for fair value less cost to sell, you're going to use or seek the help of an expert. Okay? So in estimating the value in use of an asset, the following steps are going to be involved. The first step is estimating the future cash inflows and outflows, okay, from continuing use and ultimate disposal. So in the case of MAS, the ultimate disposal is known as the terminal value. And applying the appropriate discount rate to those future cash flows. So that's very, actually, if the information or if the data are already there, it's very simple. You simply get the cash flow, you multiply it by the present value factor based on the discount rate identified. So that's very easy. The difficult part is actually estimating and computing for the future cash flows. So what will be the basis for our estimates of future cash flows? Okay? So in measuring value in use, the entity shall, first of all, letter A, because we have A, B, and C here. So first of all, base cash flow projections on reasonable and supportable assumptions that represents management's best estimate of the range of economic conditions that will exist over the remaining useful life of the asset. Greater weight shall be given to external evidence. So take note that similar to assessing whether there is impairment, there is also evidence that we need to look for, which are either external, internal evidences of the cash flows. So greater weight shall be given to the external evidence because it is more independent and more objective. So we need to determine the projected cash flow assumptions. Letter B, base cash flow projections on the most recent financial budgets, forecast, or other particular documents approved by management, but shall exclude any estimated future cash flows expected to arise from restructurings, enhancements, improvements, etc. And it shall cover a maximum of 5 years only, unless a longer period can be justified. So to make letter B shorter, you just simply determine the cash flows at the current condition of the asset. Okay? And for a period of a maximum of 5 years, okay, as a general rule, unless a longer period can be justified. So that's basically for letter B. And then letter C, estimate cash flow projection beyond the period covered by the most recent budgets or forecasts by extrapolating the projections based on the budgets or forecast using a steady or declining growth rate for subsequent years unless an increasing rate can be justified. This growth rate shall not exceed the long-term average growth rate of the products, industries, or countries in which the entity operates, or for the market in which the asset is used, unless a higher rate can be justified. So basically, what are we trying to say here? If let's say for example, because based on the standard, the maximum projection should only be for 5 years. But if you can justify that you can still generate cash flows for more than 5 years, then for the remaining periods, like example year 6, year 7, year 8, etc., you need to use a projection that will be extrapolated. So meaning you are going to determine the future amounts, okay, by determining a growth rate that is either steady or declining. But of course, again, this should be justified. So all of the items or all of the computations that you're going to do, particularly the rates and the amounts, should be justified. Okay? So in board examinations, but I'm not sure if there are already problems that were provided, but we have that particular problem um in the next part of the playlist of the videos, which wherein we have the sample problems. Basically, the concept is after year 5, you're going to compute for the succeeding cash flows by multiplying the last cash flow or year 5 cash flow with the growth rate. So example, if the cash flow for year 5 is 200,000 and you expect a 2% growth rate, then 200,000 multiplied by 1.02 is going to be 204,000 if I'm correct. So that's going to be the cash flow for the succeeding period. Okay? And you're going to continuously do this until you get the total projections for the entire year or the total number of years that you expect to generate cash flows. And then from there, you multiply those cash flows by the present value factors. Okay, so that's how you do it. Okay? Um, in estimating the cash flows, the projections will include the following. So projections for cash flows from continuing use, projections of cash outflows that are necessarily to be incurred to generate the cash flows from continuing use, including cash outflows to prepare the asset for use, and can be directly attributed or allocated on a reasonable and consistent basis to the asset. So this can include cash outflows to prepare the asset for use are actually day-to-day servicing also. So you can also add those day-to-day servicing. Net cash flows, if any, to be received for the disposal of the asset at the end of its useful life. So those are the components of your cash flows. Um, to emphasize, again, we need to understand that when we are going to get cash flow A, B, and C, we are not supposed to consider any cash flows from enhancements, improvements, uncommitted cash flows. We are not supposed to include cash flows from financing. We are not supposed to include cash flows for taxation because those items are specifically stated in the standard as excluded. Okay, and these are going to be separately determined later on in other sections of the financial statement. Okay, so basically to make it as simple as possible, the cash flow projections should be based on the current condition of the asset. Okay, so the estimate of net cash flows to be received or paid for the disposal, so this is specifically for the disposal, it will be based on the disposal amount or the disposal value of the asset in an arm's length transaction. So again, this is fair value. So the projected cash flow for the disposal should be based on the estimated fair value on the date of disposal and then subjected again to fair value. So since we are talking about cash flows, we also need to determine where the cash flow will be coming from. So it is possible that cash flows are domestic currency cash flows or foreign currency cash flows. So in that case, according to the standard, future cash flows that are estimated in the currency in which they will be generated and then discounted using the discount rate appropriately for that currency shall be translated, okay, based on the spot exchange rate at the date of the value in use calculation. Okay? So meaning after you got all the projections, So you got the cash flows, you got the discount rate, you multiplied it already at the date. So example, you are preparing the value in use calculation today, then the spot rate for the exchange rate for, let's say for example, the cash flows are in dollars and you're going to translate that to pesos, then you get the exchange rate for dollar versus peso during or based on the spot rate today, and then translate it to pesos, and then that will be the basis of your value in use, which will be compared to the fair value less cost to sell, which will eventually be compared to the carrying amount to determine the impairment loss. There. And then, of course, one of the most important factors will be the discount rate, because you already know the cash flows. You also need to get the discount rate, because the discount rate will be the basis of your present values. So the discount rate or rates shall be the pre-tax rate. So again, similar, if the cash flows are not or will not consider the tax amounts, that discount rate are also going to be pre-tax rates. Okay? That reflect current market assessments of the time value of money and the risk specific to the asset, which the future cash flow estimates have not been adjusted. Okay? So take note, the risk specific to the asset for which the future cash flow estimates have not been adjusted. So meaning these are pre-tax and pre-adjusted. Okay? So meaning we are simply going to base it on the market conditions that are existing. Okay? And take note, the discount rate can vary. It is possible that the discount rate is only a single rate or a single percentage for the entire period of the computation, or it can be multiple rates depending on the market condition. So, like example, if based on the estimates of your actuaries or your professionals, professional valuators, if the discount rate for year 1 is 13% and then for year 2 it's 12%, then you simply follow that. Okay? Anyway, it's very easy to compute the present value once you already know the discount rate. Okay? So with that, we already know the carrying amount because the carrying amount is already reflected in the FS. Number 2, you already know the recoverable amount because the recoverable amount is the higher between the fair value less cost to sell and the value in use. So with that, we can now recognize and measure the impairment loss. So again, to emphasize, if and only if the recoverable amount of an asset is less than the carrying amount, then the carrying amount of the asset shall be reduced to its recoverable amount, and that reduction is known as the impairment loss. An impairment loss shall be recognized immediately in profit or loss unless the asset is carried at revalued amounts in accordance with another standard, example IAS 16 for those using revaluation model. Any impairment loss for a revalued asset shall be treated as revaluation decrease in accordance with other standards. So, the basic concept is similar to what we discussed when we were having the discussion for PPE. So, in the case of impairment, before we recognize any impairment loss, we need to determine first if there are any revaluation surplus or similar amounts that are adjunct to the asset that is being impaired. Because prior to recognizing impairment loss, we need to fully deduct first, or we need to deduct first any amount of revaluation surplus or similar item, and then any unabsorbed portion will now be recognized as impairment loss. So when the amount estimated for an impairment loss is greater than the carrying amount of the asset to which it relates, the entity shall recognize a liability if and only if it is required by another standard. So again, any estimate for impairment loss is recognized immediately in profit or loss, and you are not required to recognize any liability unless it is required by other standards, such as if you're going to recognize estimated liabilities for provisions or any other items that are related to the asset. Then, after the recognition of an impairment loss, the depreciation or amortization charge for the asset shall be adjusted in future periods to allocate the asset's revised carrying amount less its residual value on a systematic basis over its remaining useful life. So, to make it simpler, because you already have a new carrying amount which is based on the recoverable amount, then your depreciation or amortization charge will also be different because your base, your depreciation or amortization base is already changed also. So the next concern is, what if we are dealing with with cash generating units? Because impairment for individual assets is very easy. You simply, uh, in fact, if we try to value an individual asset, we can easily determine its fair value less cost to sell, or fair value less cost of disposal, and value in use, because we are only talking about one asset or a single asset. But if we are talking about a cash generating unit, which is a group of assets that generate independent cash flows, then determining the recoverable amount and impairment is actually a bit more difficult, particularly because we still have goodwill to account for. So according to the standard, let us first have this topic: identifying the cash generating unit to which an asset belongs to. Okay? So if there is any indication that an asset may be impaired, recoverable amount shall be estimated for the individual asset. If it is not possible to estimate the recoverable amount of the individual asset, an entity shall determine the recoverable amount of the cash generating unit to which the asset belongs. Okay? So, um, this means that the basic concept here is, what if an asset that belongs to a cash generating unit is impaired? Are we going to recognize the impairment loss immediately or not? So the concept there is, the recoverable amount can be estimated based on the individual asset. But if it is not possible, then we need to get the recoverable amount of the entire cash generating unit where the asset belongs to. If an active market exists for the output produced by an asset or group of assets, that asset or group of assets shall be identified as a cash generating unit, even if some or all of the output is used internally. So in this case, we can actually determine already the recoverable amount of the asset. Okay? So if the cash inflow generated by any asset or cash generating unit are affected by internal transfer pricing, okay, an entity shall use management's best estimate of future prices that could be achieved in arm's length transaction in estimating the future cash flows of the asset or cash generating unit and future cash outflows to determine the value in use. So similar to our individual asset. Okay? So how do we determine the recoverable amount and carrying amount of the CGU? The carrying amount of a cash generating unit shall be determined on a basis consistent with the way the recoverable amount of the cash generating unit is determined. Okay? Again, carrying amount shall be determined on a basis consistent with the way recoverable amount of the cash generating unit is determined. Okay? So how do we determine the carrying amount of the CGU? So it will include the carrying amount of only those assets that can be attributed directly or allocated on a reasonable and consistent basis to the CGU, and will generate the future cash inflows used in determining the value in use, and does not include the carrying amount of any recognized liability unless the recoverable amount of the CGU cannot be determined without consideration of this liability. Okay? So, basically, to make it simpler, in determining the carrying amount of the CGU, you get the value of all the assets and any liabilities that are attached or directly attached to that particular asset, such as mortgages or whatever types of liabilities that will always be attached to the asset whenever it is going to be the subject of any transaction. Okay? So, allocating goodwill, okay? Because goodwill is actually part of the value of the CGU. So, what are we going to do? For purposes of impairment testing, of course, we need to allocate the goodwill. Okay? So, how do we do that? Okay? In determining the value of the goodwill, it's going to be like this. Each unit or group of units to which the goodwill is so allocated shall first represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, and not be larger than an operating segment as defined by paragraph 5 of IFRS 8, which is operating segment. So this will be discussed in IFRS 8. But anyway, the concept is like this. If we are going to allocate the goodwill, we need to identify first all the cash generating units that benefits or that are um, where the goodwill was emanated from. Or meaning, when we acquired the goodwill, what CGUs or which of the following CGUs were actually involved in the acquisition of the goodwill. And then after that, we are going to allocate that on a systematic basis, generally based on the values of the CGU. So pro rata based on the value of the CGUs, excluding the goodwill, of course. Then from there, we can now get the value of the CGU together with the allocated goodwill. Okay? If the initial allocation of goodwill acquired in a business combination cannot be completed before the end of the annual period in which the business combination is affected, the initial allocation shall be completed before the end of the first annual period beginning after the acquisition date. Okay, of course, this is already a matter of IFRS 3. But basically, the concept here is you use the earliest information or the most or the earliest, sorry, the most recent information, even if it is not yet the final amount or the final valuation, as the basis of your allocation of the goodwill. Because of course, it is a matter of determining the allocated amount of the goodwill. So if the allocated goodwill was not yet completed prior to the annual period, we use first the most recent information about that goodwill. Okay? If goodwill has been allocated to a cash generating unit and the entity disposes of an operation within that unit, the goodwill associated with the operation disposed of shall be included in the carrying amount, of course, and measured on the basis of the relative values of the operations disposed of and the portions of the CGU that were retained, unless the entity can demonstrate that some other method better reflects the goodwill associated with the operation disposed of. So, in the absence of any other information, we simply use the relative fair market value or relative value of the CGU as the basis of allocation of the goodwill. Okay? If an entity reorganizes its reporting structure in a way that changes the composition of one or more CGUs to which goodwill has been allocated, the goodwill shall be reallocated to the units affected. So meaning, initially you have a different grouping of CGU. And then during the current period, you made a restructuring and you made a different grouping already of CGU. So what are you going to do? You simply reallocate the goodwill based on the new groupings. You get the values of the CGUs, pro rata, get the fraction, and then you multiply it with the goodwill for you to get the goodwill associated with the CGUs based on the new groupings. Okay? We now go to the testing of cash generating units with goodwill for impairment. So the standard simply states the unit shall be tested for impairment whenever there is an indication that the unit may be impaired by comparing the unit's carrying amount excluding any goodwill with its recoverable amount. So that's very simple. Okay? And then, when are we going to do the impairment testing? The annual impairment test for a CGU to which goodwill has been allocated may be performed at any time during an annual period, provided the test is performed at the same time every year. Okay, for comparability purposes. Okay, so you can do it anytime during the year for as long as you're going to do it on the same time period in the next during the succeeding periods. So meaning, if you did the impairment testing July this year, next year you will also do it July. Okay? If you did it at third quarter during this year, you also do it third quarter of the succeeding year. So that we can have a better comparability of the information. Okay? The next question is, what if we have corporate assets? Again, corporate assets are the common assets that are or where all, or if not most of the cash generating units are also benefiting from. So meaning these are shared assets. So what are you going to do with corporate assets? So the basic concept is, if you can allocate the corporate assets on a systematic or an objective basis, then you also recognize these assets, or you also allocate these assets in determining the value of the CGU. Okay? So that's basically how it works. Okay? So it says here, as a consequence, if there is an indication that a corporate asset may be impaired, recoverable amount is determined for the cash generating unit or group of CGUs to which the corporate asset belongs and is compared with the carrying amount of this cash generating unit or group of cash generating units. Okay? So that's basically how it works. So because a corporate asset is servicing or is helping CGUs, when it is impaired, it is also possible that the entire CGU or the CGUs where the corporate assets are being used will also be impaired. But again, to reiterate, anyway, let's just read this first, and then I will give the guidelines later on. Let's have the impairment loss for CGUs. So the impairment loss shall be allocated to reduce the carrying amount of the assets or the assets of the unit or the individual assets in the following order. Okay? So these rules have actually been existing for since early 2000s. There have been very minimal changes in allocation of your impairment loss. So in case of CGUs, the first item that will absorb the impairment loss will be the goodwill. Okay? And then afterwards, two other assets already on a pro rata basis. Okay? So that's what you're going to do. You get the total impairment loss, allow the goodwill to absorb it first, and then any other amount that is not yet absorbed by the goodwill will be allocated to the individual assets belonging to the CGU. Okay? So in allocating the impairment loss, an entity shall not reduce the carrying amount of an asset below the highest of, okay, below the highest of its fair value less cost of disposal as an individual asset within the group, its value in use if determinable also, and zero. So in other words, if you are going to allocate impairment loss, the asset or the individual asset should not be reduced beyond its recoverable amount as an individual asset or beyond zero. Okay, so if let's say for example, when you used a pro rata computation, the amount of impairment loss allocated to equipment A is 500,000. Okay? So meaning we need to reduce equipment A by 500,000. However, when we check the recoverable amount of equipment A as compared to its goodwill, we determined that the carrying amount was 1 million and the recoverable amount was 700,000. Okay? So meaning if we make the computations, 1 million minus 700,000 is only 300,000. So even though we made or we computed 500,000 for the initial pro rata computation, since we already determined that the maximum impairment that will be absorbed by equipment A is only 300,000, then that is the only amount that we're going to allocate. So what are we going to do with the remaining 200,000 that was not allocated? We allocate it again to other assets on another pro rata computation. Okay? So that's how we do it. Okay? And of course, we cannot, or an asset cannot absorb impairment beyond its carrying amount. So if let's say for example, you were able to compute the project, or you were able to compute the impairment loss allocation to equipment B at 400,000. However, equipment B only has a 400,000 carrying amount. So of course, this equipment cannot absorb beyond 400,000. So if that's 500 versus the 400,000 carrying amount, what will happen to the remaining 100,000? Again, you do the same. You make another pro rata computation for the remaining assets that still have positive values. So that's basically how it works. Okay? The amount of the impairment loss that would otherwise have been allocated to the asset shall be allocated pro rata to the other assets of the unit or group of assets, as what I already stated a while ago. Okay? before we proceed with the reversing of impairment loss, we need to understand how it works when an individual asset within a cash generating unit is impaired. Okay? How are we going to account for its impairment loss? Okay? So it's basically like this. First rule, you need to determine whether you are going to retire that particular asset or that particular um, impaired asset, or whether you are going to continue using it. Okay? Because if you are going to retire the asset and replace it with the new asset, then you need to compute for impairment as an individual asset. Okay? However, if you intend to continually use the asset or the impaired asset as part of the CGU, then that's the time that you need to compute for the recoverable amount of the CGU in total. Okay? And then we determine if it is really impaired. So to give an example, it's basically like this. Let's say machinery 1 of a CGU has a carrying amount of 1 million and a recoverable amount of 800,000. So obviously, there is a 200,000 impairment loss. So question number 1, or scenario number 1, if the entity intends to sell or to replace this particular or this particular machinery, then we will recognize automatically the 200,000 impairment loss. Okay? However, scenario number 2, the company does not intend to replace the asset but rather continuously use it. So in that case, we need to determine whether the CGU is impaired. Okay? So, based on the computation, the carrying amount of the CGU is 5 million. The recoverable amount of the CGU is 5,500,000. Or in other words, it is not impaired. Therefore, we are not going to recognize the impairment of the individual machinery that was impaired because the CGU is not impaired. Okay? So again, to reiterate, an asset that belongs to a CGU which is impaired will not automatically result in the recognition of an impairment loss because it depends on the situation whether it is going to be replaced or it is not going to be replaced. Okay? So it's a matter of a case-to-case basis in determining the recognition of impairment loss. Again, we also have an example like that in our next videos, particularly talking about impairment. Okay, so we are down to, I think this is the second to the last topic. What if there is already a reversal of impairment? Okay? So the concept of reversal of impairment is basically you recognize an impairment loss and then in the succeeding periods, there was an increase in recoverable amount. And because there was an increase in recoverable amount, we need to recognize a reversal of impairment. Okay? So according to the standard, an entity shall assess at the end of each reporting period whether there is any indication that an impairment loss recognized in prior periods for an asset other than goodwill may no longer exist or may have decreased. If any such indication exists, the entity shall estimate the recoverable amount of that asset. In assessing whether there is any indication that an impairment loss recognized has actually reversed or has decreased, we need to consider again external and internal sources, similar to what we were doing in the previous topics. So, what are external sources of information that may be an evidence of reversal of impairment? So first is, there are observable indications that the asset's value has increased, which is significant to the prior valuation. Letter B, significant changes with a favorable effect on the entity. Take note, in the previous, in our previous discussion, if it is going to be unfavorable or adverse on the side of the entity, then it's going to result in impairment. If the change is significant and it is now favorable on our part, then it is now going to be an indicator of your reversal of impairment. Letter C, market interest on other market rates and other market rates on investments have decreased. So a decrease in the market rate will result in an increase in the value or the present value of the assets, which means that it's going to result in increase in value. So there will be reversal of impairment loss. For internal sources, so as you can see, these are just reversals of the indicators of impairment. Significant changes with favorable effect again pertaining to um, performance of the asset or intentions of management on its use, etc. And evidence available from internal reporting that indicates that the economic performance of the asset is better than expected. Okay? So if these are existing, then we can actually reassess the recoverable amount of the asset and determine if reversal of impairment loss is necessary. So it says in the standard, an impairment loss recognized in prior periods for an asset other than goodwill shall be reversed if and only if there has been a change in the estimates used to determine the asset's recoverable amount since the last impairment loss was recognized. So meaning, um, we are going to use the same method that we used to determine impairment loss. We're simply going to reflect the new amounts or the new indicators or cash flow predictions that are existing currently and then determine if there are going to be reversals. Of course, it will exclude goodwill. Okay, take note, we will not include reversal of goodwill impairment. So, the increased carrying amount of an asset other than goodwill attributable to a reversal of an impairment loss shall not exceed the carrying amount that would have been determined net of amortization or depreciation had no impairment loss has been recognized for the asset in prior years. So meaning, we cannot recognize we cannot recognize a reversal which is in excess of the carrying amount should there have been no impairment that happened. Okay, so meaning, what you're going to do is you're going to compare the current carrying amount with the carrying amount if there are no impairment and the current recoverable amount. Okay? And then from those three, you always need to consider that the maximum impairment reversal that you can have is actually the difference between the current carrying amount and the carrying amount as if no impairment happened. Okay? However, again, if you are using revaluation model, any excess of the recoverable amount over the carrying amount should there have been no impairment loss that were previously recognized will be recognized in profit or will be recognized as revaluation surplus. Okay, so for us to understand, let us have an example. So let us assume the carrying amount of the asset right now was 1 million or is already 1 million. When you determine the recoverable amount was 1,800,000. Okay? And when you determined the carrying amount, considering that no impairment happened, the asset would have a value of 1,500,000. Okay? So, the current carrying amount is 1 million. If there were no impairment, that's 1,500,000. And the current recoverable amount based on the computation was 1,800,000. Okay? So, the maximum reversal of impairment loss will only be between 1 million and 1,500,000. So, meaning, the reversal of impairment loss is 500,000. Okay? What then is the importance of 1,500,000 and 1,800,000 or the 300,000 difference? The 300,000 difference is only relevant if the entity is using fair value or revaluation model. Because in that case, the remaining 300,000 will be recognized as gain on fair value change or revaluation surplus. Okay? Now, let us have another example. If let's say, for example, the current fair value or the current carrying amount is 1 million, the carrying amount if there are no impairment loss was 1,500,000, and the recoverable amount that was computed was 1,300,000. How much then is the reversal of impairment loss? The answer is 300,000 only, which is the difference between 1 million and the 1,300,000 which was assessed as the new recoverable amount. Okay? The 1,500,000 is not relevant in this case because it was not exceeded. Okay? That's the maximum, but that does not mean that it is always the amount to be recognized. Okay? Anyway, we have other examples in the next portions of the video, in the playlist. Okay? A reversal of an impairment loss for an asset other than goodwill shall be recognized immediately in profit or loss unless the asset is carried at revalued amount in accordance with other PFRSs such as IAS 16. Any reversal of an impairment loss of a revalued asset shall be treated as a revaluation increase in accordance with that other IFRS. So similar to what I said already a while ago. After a reversal of an impairment loss is recognized, the depreciation charge or the amortization charge shall be adjusted again for future periods based on the new depreciation or amortization base that we have. So of course, as expected here, the depreciation or amortization charge will increase because the base is already increased also. Okay? A reversal of an impairment loss for a cash generating unit shall be allocated on or to the assets of the unit except for goodwill pro rata with the carrying amounts of those assets. Okay? And these increases in carrying amount shall be treated as reversals of impairment loss for individual assets. So similar to how we do it for individual assets. The thing here is we simply pro rata or prorate it. Okay, similar to how we prorate the impairment loss, the reversal shall be allocated also based on the same ratio, okay, or on the same computation as when we computed the impairment loss. Okay, in allocating a reversal of impairment loss for a cash generating unit, the carrying amount of an asset shall not be increased above the lower of its recoverable amount and the carrying amount that would have been determined net of amortization or depreciation had no impairment loss have been recognized for the period. Okay? So the allocation of the reversal, okay, shall not be increased above, okay, the lower of the two items. So similar to when we were allocating impairment loss, okay, the reversal also is on the same basis. Okay? So meaning if you were computing for the recoverable amount of the individual asset that belongs to the cash generating unit, you cannot increase its value beyond its actual recoverable amount and or its carrying amount if no impairment happens. So meaning the maximum increase, okay, the maximum increase of that particular reverse or the maximum increase of the said individual asset belonging to the cash generating unit will be the lower of the two items. So you need to compute for the two and then get the lower amount. That's the new recoverable amount or new carrying amount of the asset. Okay? The amount of reversal of the impairment loss that would otherwise have been allocated to the asset shall be allocated again pro rata to the other assets that do not have individual recoverable amounts or carrying amounts. Okay? An impairment loss recognized for goodwill shall not be reversed in a subsequent period. Okay, meaning goodwill can be impaired but it cannot be recovered anymore. Okay? So with that, we go to the disclosure requirements. So general disclosures will be the following. The amount of impairment losses recognized in profit or loss during the period and the line items of the statement of comprehensive income in which those impairment losses are included. So meaning you provide details on the impairment losses that you recognize during the period. Letter B, the amount of reversals of impairment losses recognized during in profit or loss during the period also. Letter C, the amount of impairment losses on revalued assets recognized in other comprehensive income during the period because of course, if there are impairment losses, there will be reversals of revaluation surplus which will be recognized in OCI. Okay? And the amount of reversal of impairment losses on revalued assets as well because it will now be reverted back to revaluation surplus. In addition, an entity that reports segment information in accordance with IFRS 8 shall also make the following disclosures: the amount of impairment losses recognized in profit or loss and in other comprehensive income during the period for each reportable segment. The amount of reversals of impairment losses recognized also for each reportable segment. So both impairment losses and reversals. Okay? An entity shall make disclosures for an individual asset, including goodwill or a cash generating unit for which an impairment loss has been recognized or reversed during the period. So you make the detailed information on the impairment or reversals of impairment for both individual assets and cash generating units. An entity shall make disclosures for the aggregate impairment losses and the aggregate reversals of impairment losses recognized during the period. So basically, you are asked to provide the details and then finally to provide the totals. Okay? So this is actually very easy because if you can indicate the individual results, you simply add the totals and then you disclose it in your notes. Okay? An entity shall make disclosure on estimates used to measure recoverable amounts of cash generating units containing goodwill or intangible assets with indefinite useful life. So meaning you need to give a basis. Or actually, in fact, this is not only required for CGUs. Okay? In fact, in all of, since you are disclosing impairment losses and reversals of impairment losses, you're actually going to provide the details of how you computed for the recoverable amount of every item that was involved in impairment loss and involved in the reversal of impairment loss. Okay? If some or all of the carrying amount of goodwill or intangible assets with indefinite useful lives is allocated across multiple cash generating units, okay? And the amount so allocated to each unit is not significant in comparison with the entity's total carrying amount of goodwill or intangible assets with indefinite useful lives, the fact shall be disclosed also, together with the aggregate carrying amount of goodwill or intangible assets with indefinite useful lives allocated to those units. Okay? So meaning, um, even if there were goodwill that were allocated, that were impaired, etc., all of those things, if these are not significant, you still need to make that particular disclosure. Okay? Because um, the amount of goodwill that might have been derecognized is not actually going to result in a significant change in the total um, financial condition or financial position of the entity. But still, you need to disclose that fact. Okay? So with that, that's the end of our presentation. So the main thing here is that we need to the main thing that we need to remember is that number one, we need to know the carrying amount of our assets. Number two, we need to determine the recoverable amount of the asset by determining the higher of the fair value less cost of disposal and the value in use, and then we're going to determine the impairment loss. In the case of impairment loss, prior to recognizing it as impairment loss, we need to determine if there are any revaluation surplus or similar items that can absorb the loss. Okay? After deducting these items from the total impairment loss, then the net amount will now be reflected in profit or loss as impairment loss. Okay? Finally, if there are possible reversals, okay, we also need to recognize the reversal by doing the same valuation technique as we did in computing the impairment loss. But always remember, for impairment losses, we are or for reversals of impairment losses, there will be no reversals of goodwill as a result of impairment reversals. So that's the end of our presentation.